What's going on, guys? It is the Zoomer Value Investor here. Here, going to do a quick little portfolio update in the beginning of this video. In the middle of the video, going to do a little talk about the economic macro. By the end of the video, I'm going to talk to you guys a little bit about what my plans are for portfolio updates, and what I want to do with portfolios on this channel going forward. This portfolio has performed amazing. Ladies and gentlemen, we have seen above 30% returns on this portfolio. Obviously, this has been with fluctuations in the market, and this statistic you're going to see on your screen, this is taken from Fidelity, and please keep in mind that Fidelity updates its performance on all of its portfolios every month at the first of every month. So you're seeing the performance metrics from this would be the 1st of September. Now, please keep in mind that the SPY, VTI, all the indexes were higher at the start of the end of September. So therefore, you know, the portfolio returns were pretty much as high as it ever been at a time like this. I'm gonna also show you guys on screen the actual portfolio, kind of what it's looking like now. Obviously, the performance isn't gonna be so miss. We've seen a pullback in the portfolio, just like we've seen a pullback in the market indexes. But I'm really liking the setup in this portfolio. I'm liking what we got, liking the new positions, liking the positions that have treated us well. Really happy with the core of Amazon, Google, Meta. And if you go back on my channel, I actually released a video around Q4 2022. That was my portfolio update back then. And I talked about actually how I added funds to this portfolio. This was originally a $1,000 portfolio, but I turned it into about a $1,333 portfolio because I saw a huge opportunity in the market, particularly after the Q4 earnings of big tech in 2022. And if you actually watch me in that video back then, I did not feel good at all about buying any of these three core stocks in my portfolio on the market at that time, because I personally believe there's a lot of room to go lower, and I had never seen sentiment that negative, that just in the gutter. It was so bad, and I just remember watching myself like back then during that video and being like, wow, like this is what investor sentiment looks like. And it was even bleeding into me, but I stuck faithful to a part of my process and got rewarded with some pretty good profits as a result of that. Ladies and gentlemen, a 30% return is crazy, but just keep in mind that there is a way we could probably calculate this. Hypothetically, take the same portfolio, but let's say all of the money in the portfolio that went from cash into Meta, if it hypothetically stayed in cash, let's reassess the performance of the portfolio then. And I don't think it would probably be about at market returns, maybe carried by things like Google and Amazon. So really what made this portfolio a winner was that one huge win on Meta. And that is one of the interesting things about stock picking. That is one of the interesting things about being in the markets like this, is one huge win like that can make, you know, or a huge loss hypothetically could break a portfolio. The data you're seeing is over a year old. Now, I consider this kind of starting to get into that territory of longer term assessment on longer term performance. Still, that's nowhere near, you know, anywhere like a 10-year window of assessment of performance, which I definitely am going to keep track of. But this data of how well we've done since the portfolio inception of April 2022 to now, I think is great proof of there is some modicum of me doing something that has a good jive to it. So Baxter International is a healthcare company, huge healthcare company, really vital in a lot of different healthcare products, especially things like IVs. And they're actually going to spin off the renal care division. So this is renal care, kidney care. This is, think about companies like DaVita, they directly compete with that. They're going to spin that off, and the idea of that is to create shareholder value. So, you know, just by owning BAX shares, you're going to get this new co, and it's a pretty legit company. So I think there might be some value creation there. I do think the company is undervalued a decent amount, but again, you know, it is kind of like a lower allocation at this time because still kind of feeling out the company, the kind of chances it goes lower, which it has at this time. So I'm gonna look to increase that at some point. It's just a matter of time. When Kilroy Realty, KRC, now this is a REIT. They have a lot of different properties out in California, but as I aforementioned, a lot of different properties out in Austin, Texas as well. So very familiar with both of those areas. The reason why I think this is trading at near 2008 levels for a REIT empire such as this is California has had a lot of different negative flack in the news lately. And I think it's starting to get to a point where it is a little overblown. And I am kind of personally interested in acquiring property through Kilroy, if that makes sense. So it's like, because I own shares of the REIT, I kind of I somewhat own the different buildings that Kilroy owns. So I own a lot of different property in Austin, Texas. I own a lot of different property in California. I mean, that's just kind of how I'm thinking about it. So when I start pouring my capital into something like Kilroy, and I think it's really attractive here. Something that's really nice is when you look at the yields of some of these REITs, what they're at, due to the selling pressure, you're actually able to buy this at prices where, when you consider the per share assessment of what the yield you're getting, it's pretty impressive. Like Kilroy, like 7% yields. Another REIT I'm really interested in, ADC. This one is approaching that 6% yield. So 6%, 7% yield. I mean, oh man, that's really high. That's really good. Those are good yields. That's like that's about like money market level. Like that's even better than money markets in this current economic. You get like 4 to 5% in the money market right now. But I mean, shoot, get that in a REIT. And then when you consider that there's a lot of undervalued potential there too, it's really nice dividend growth setup. I think it's too hard to ignore. So I think REITs has a pocket of market that investors, they can't ignore right now. Lastly, we're going to talk about Hanes Brands now. This is pretty much a turnaround. I think there's a lot of value creation they can do here. They're looking for a deal for their champion brand. I think this was a good idea. They had to sell it off at the right price, obviously. I mean, we need like $1 billion plus price tag for Daniel Champion. Definitely like for Hanes, they need to kind of be a little greedy here. I know it's not really the optimal market to, just get hard cash, but the champion brand definitely is worth the money. It's just a matter of finding the buyer. But I think it's a good idea for them. They can just focus on their innerwear then at that point. And I think there has been good value for Hanes in a brand like Champion. Yeah, they maybe are getting rid of it, but it's gonna bail them out of a tight spot if they do sell it at a good price. Another thing to consider is a lot of the pressure from Hanes comes from the pressure you see in a stock like Target. So when the pressure of something like Target starts to turn around, if you see Target back at something like $200 Target, and Target's like, oh my gosh, look at our sales, particularly in like clothing, something like that. Our clothing sales are back up, and $200 stock price, because obviously a lot of their different other like stuff would be up too, right? So like tech sales, all that, Target does, grocery, whatever, who knows, even all that might be up too. But the point is that it'll be a different market environment, maybe 1, 2, 3 years out. At a time like that, I think Champions, it can roar in the teens, teens, $20 stocks, something like that. Absolutely very possible for something like this. A lot of the issues they went through was just kind of like bad management, bad rotation from the management. It was bad use of the capital, the company's capital, in the current interest rate environment. Just bad use of it, putting it and rotating it into different bonds and such. So that really set a huge selling pressure in that were, in combination of them saying, hey, we effed up and lost millions because we didn't rotate based on the, economic environment. They didn't play that well. And the other thing was like, they have to also tell all the shareholders at the same time, we're not really selling like, we're supposed to sell. And a lot of that has to do with, again, something like Target. Target's just use stuff like that. So let's talk about the economic macro for a second, shall we? Now, here's what I think is going on with the economic macro. We're in a pretty interesting environment where let's say the SPY, right, the S&P 500 index, it has pulled back from, on the recent rally, about 450 basis points. When you consider the all-time high was somewhere around December 2021 of 485 basis points. We saw a lower high of 450 really recently, but now we're sitting at a very critical resistance of 420 on the SPY. Now, what's really interesting to me is this resistance point of like 420, 410 on the SPY. I think these are pretty good levels to accumulate. These resistances go way back to a lot of different levels in 2021, 2022. So I think it's a matter of time until SPY just trades higher from these levels. I think it's pretty safe to be a buyer. It's a buyer's market for stocks. I think pretty decent stock pickers market here. If you wanted to be a stock picker, the pockets I would really suggest maybe start looking into would be REITs, like ADC, Kilroy Realty, KRC. Look into something like a lot of different media plays out there. One I'm really interested in is Disney, DIS. You can see we have started a little Disney position in the portfolio that will be built out bigger. Obviously got a good amount of shares in my personal holdings already. There's a lot of different consumer plays that are really interesting out there. You know, the Dollar Generals of the world. Hanes is a pretty interesting turnaround. And lastly, biotech. So, you know, as I mentioned, you know, BNTX, but also what I think is honestly more interesting, which I don't have the risk tolerance to put into a portfolio like this. You know, again, I treat this as if I'm managing someone else's money. But what I think would be really interesting is a stock like, which I don't know a ton of in my personal portfolio, which I take a ton more risk in. So stocks like Intelia, NTLA, stocks like Upseller, ABCL. I think those are super interesting right now. So I honestly plan to retire this portfolio. I kind of want to just transfer all this into my personal portfolio, and I'll look to restart this kind of experiment on a kind of different basis in the future. One thing I wanted to think about maybe doing was setting aside another little handful of cash and doing something maybe like a small cap portfolio. So it's like, let's see if we buy companies that are under like $2 billion market cap or something like that and see how we can do, or some of that nature, just kind of like mixing it up. Just kind of have some like things in my life I want to like kind of like maybe start using this money for or something like that. So, but I'm not immediately touching this portfolio at all. Gonna leave it for now, but definitely would consider that this might be the last update you see. I kind of want to explore doing like some other things on the channel and things like that, but it was really nice running this experiment with y'all, just kind of being really open about like, hey, these are some of my assets and this is how they've been doing over this period of time. And I think it was really cool, and I hope that some people kind of learn things on the way. I know I learned a lot of things. One thing that I'm really going to crack down personally is value traps, kind of like reading into them more bits, things of that nature. So one thing I want to point out about portfolio management is really how you win is it's small wins, big wins, small losses. That's it. That's all you got to do. Just play the game like that, and you can probably find a good amount of success. So some trades I want to point out is Citigroup. We got into Citigroup, we got out of it. Small loss, small slap on the wrist, not a big deal. Took like a $4 loss in this portfolio on that, but took that capital back, putting in some other things. Again, got to study value traps on that one. So that's something I'm kind of doing, and no huge harm there. It just things happen, and re-enter Citigroup if the price gets even more attractive. Honestly, just kind of depends on the market, the story, etc., etc. Hasbro, again, that was pretty much a home run. That goes as good as you can.